An indirect cost rate is nothing more than a percent. I've typically used 13.7% in all my examples, and that's all an indirect cost rate is. And it's derived from a very simple calculation, A over B. That's all it is. We make it look like it, I alluded to, take 80 hours to compute it. Not quite. A good CFO can probably do an indirect cost rate calculation in an hour if the accounting system is set up properly. And it's nothing more than the sum of an organization's indirect costs divided by the sum of the organization's direct costs. It's A over B, and the result is usually, since direct costs usually exceed indirect costs, it's usually a number that's less than 1. So it's 0.137 or 13.7%. That's all an indirect cost rate is. So it's a ratio of indirect costs in the A, direct costs in the B. That's all it is.
That works well. A over B works well with one contract. And how would you take the indirect and allocate it over multiple contracts?
I'll probably draw some stuff up on here to show you in just a minute, if I don't answer that question. So the indirect cost rate proposal is what you submit to the cognizant agency. And that's actually a document you guys produce. And that document has to consist of certain items, and we'll talk about what constitutes an indirect cost rate proposal. But before we do that, I would be remiss if I didn't say this involves some work that may not get your agency an additional penny in federal financial assistance. If all of your grant programs are as tight as 5311 is, it may not do you any good to do an indirect cost rate proposal. I sat in an office in Lexington, South Carolina, and just had the city manager. I had just given in this whole spiel, an hour's worth of embellishments of why all his department managers would be better if they knew what their fully allocated costs were. And he just looked me in the eye and said, "Am I going to get any more money from this?" And I said, "Possibly not." He said, "I'm not telling my managers to do it. If it's not going to get my city any more money, I'm not going to do it. I'm not going to go pay Dewey, Cheatham, and Howe, our CPAs, an extra $10,000 to do this." He goes, "I'm just not going to do it. It doesn't make sense." And then he invited me out of his office. And I can't blame him. To be in the city management business, it's a tough business to be in. You got to be hard-nosed. He was very hard-nosed about this. So you may not be able to convince the powers that be on your board of directors or within city or county management that is something that you need to do. But if I'm a transit manager, and certainly if I'm a transit manager that sells service to other organizations, how can I sell the service if I don't know what it costs me to produce a unit of service, a revenue mile, a passenger trip? I can't sell if I don't know what it costs. Take Coca-Cola Company. Do you for one moment think that Coke doesn't know what it costs to sell a can of soda, a liter of soda, a case of soda? They probably know down to 15 places of decimal precision what it costs that company to sell Coke or to produce Coke. It's always been my business philosophy that we in transit, particularly if we're going to sell service to other human service organizations, ought to know what it costs to produce a unit of service. If we're not including HR cost, we're not including Legal. We're underreporting. We're undervaluing what it costs our services to be delivered, and we may be undercharging in third-party contracts. So I think there's some merit in doing this full cost identification exercise, and from there it's just a small step to go the last mile and complete an indirect cost allocation plan. And while it may not get you any more drawdown on your federal financial assistance, it will make you better managers, will make you more accurate in your cost projections and the like. So I think, personally, it's a useful process. If you feel otherwise, I understand your position. And here are some of the issues that typically are confronted by advocates who support full cost identification. And here are some of the arguments that the city manager in Lexington, South Carolina, threw me out of his office over. He just didn't see the value of some of those elements. I think there's a lot of value in these elements. In particular, just look at under NTD. Some of the nation's transit monies are allocated via formula reported under NTD. If I'm under, and a lot of comparisons are made, peer-to-peer comparisons of transit performance. And when we calculate certain key performance metrics, cost per hour, cost per passenger, typical measures that we all utilize when we write up transit plans and the like, if I'm fully reporting my costs and you're not, your metrics are going to be better than mine, but it's a bogus comparison. Old computer programming concept, garbage in, garbage out. Put in bad numbers, you're going to get bad numbers out. I'd rather have good numbers coming out of it. So I think there's some merit to the position of full cost identification, even if it can't get me any more money. Now, when you read the super circular appendices, either Appendix 4 or Appendix 7, they will talk about methods of indirect cost allocation. There's something known as the simplified method, which is what we'll talk about. There's a multiple allocation-based method, which I suspect will not apply to anybody in this room, but there is a possibility. There are special indirect cost rates because OMB basically grants FTA with the power to do anything they want in negotiating and approving indirect cost rates. And if FTA wants to go off script because of unique circumstances, OMB empowers them to do so. Those are typically what we call special indirect cost rates. I haven't known FTA to deviate from the playbook, however. And then there's this newfangled thing called the de minimis rate. And it's limited to only those organizations that have never before negotiated an indirect cost rate with the federal government. Now, recently in Ohio, because RLS has a long-standing presence, our corporate headquarters have always been in Dayton, Ohio since 1989. We had some former personnel who worked at an organization back in the early 90s when there was in fact an indirect cost allocation plan. We get a call from ODOT, Ohio DOT, saying that this agency had applied for the de minimis rate, submitting grant proposals and requisitions for payment using the de minimis rate. And they had the same notion that our staff had. They don't qualify for the de minimis rate because back in the 90s, they had an approved federal rate. But due to people turnover, failing memories and the like, no one in that organization had a historical record that they had previously had a negotiated rate. That's a challenge. You've got to look at your records, your history, former personnel to make sure that you meet the qualifications, standards, that you've never had the indirect cost rate before. And if you can meet that test, this new de minimis rate could be for you. Generally, it's the simplified method that is the A over B. Your question might have been multiple allocation basis, which usually is better suited for the New York Cities, the Seattles, the Atlantas of the world. For most smaller organizations, annual budgets under 20 million, usually the simplified method works. And it usually works well for virtually all nonprofits.
What's the ratio when it's over 20 million?
What's that?
What's the ratio when it's over 20 million?
Well, there's no rule of thumb. It will vary organization by organization as to what your indirect cost rate, depending on your accounting practices, your approach to cost classification, whether you say tomato or whether you say tomato, will make a difference in these categories. And what you have to do from your accounting software is dump some data. Indirect cost rate computations, the A over B, always predicated on historic data. It's audited data. And so anybody reviewing, negotiating, and approving your indirect cost rates are going to want to tie your worksheets back to an audit statement. So that means what's everybody in the audience, some of you may have your FY17 audit reports in hand, but not your 18 yet, right? Is that about right? A little too soon for FY18 for the auditors to be done. So we'll be working with data that's about 18 to 20 months old when we're doing our A over B calculation. That's number one. Number two, we've got to pull out certain transit or any program-related expenses. The expenses that we exclude are capital. So we never include capital. And we've got to exclude unallowable expenses. So if at the end of the year we spent $1 million, we'd have to deduct anything we spent on buses and, excuse me, and other capital, and anything in that unallowable category. Those floral centerpieces, the flowers we sent to the family of the driver whose spouse deceased on us during the year, we would deduct unallowable expenses. And we'd essentially, what we do is that we then in our remaining allowable expenses, we just line up program 1, program 2, etc., and we list all of our expenses in those categories, and then we come up with a sum. And we add these together. Program 1, direct expenses. Program 2, direct expenses. Program 3, direct expenses. And that becomes B. And we take what we've accumulated in our accounts, F and A, we add them together, and that becomes the A. And we end up with A over B, and we calculate the percentage. That's as complicated as it gets in the simplified method. That's what we do. And so we end up with a percentage. I'm getting way ahead of myself. But essentially then, once we have the percentage, the way it works is we apply it to the sum of our allowable direct costs during any billing period. So because I'm terrible at math without Excel, I'm going to create a very simplified example. If we had $100 in allowable direct costs for the month of October, we would take that $100 times our indirect expense rate, 13.7, and we'd multiply that number, and we'd come up with $13.70. That would be the sum of our indirect expenses allocable to transit for the billing period October 2018. Then we'd submit an invoice to GDOT for $113.70, because we would add our direct expenses plus our allocable portion of indirect expenses, $100 plus $13.70 minus rebates and credits. Let's assume we had no rebates and credits in the month of October. So our bill to GDOT would be $113.70. That's how it works.
So, Rich, on the reimbursement form, they would plus out the indirect cost for the allowable cost, rather than just taking the whole billable expenses as a whole and giving a percent.
Yeah, see, you were out of the room when we were talking about the direct allocation method. There are situations in smaller entities that make a determination that the amount and extent of indirect costs are very nominal, rather than go through the whole rigmarole of developing an indirect cost rate proposal and applying it. They use what's known and what we showed as the direct allocation method. And we went through a couple. We defined, that's not right there. Where did I do it? Well, there's something known as the direct allocation method. I was in that slide. So, for example, if facility rent was the only indirect expense that an organization put in the F&A category, indirect expenses, rather than do a whole indirect cost rate proposal, they could just simply, in their grant application, say we use the direct allocation to allocate the following indirect expenses: facility rent. And they would then explain to you their allocation basis is fair square footage consumed by each program that occupies the building. If transit occupied 50% of the square footage, then transit would be billed 50% of facility rent costs. And that would be reflected as a direct expense in the USOA accounts. We got down, I forget what the new account number is for facility rent. It used to be 512.12. I don't know what it is in the new nomenclature. They would show it as a direct expense, but they would have told you in the grant application that they use the direct allocation method because they're so small, so dependent on federal grant funds, that they try to drop everything into the direct bucket. And so when you're limited to very few indirect costs, the direct allocation method is allowable and even recommended. Reduces everybody's headaches. There is an obligation to inform the grantor agency what line items they're using it on and what the allocation base is. And there's a guide on that you could use to test whether they're using an equitable allocation base that we'll talk about in a minute. But to answer your question, yes, there would be essentially a series of account codes that would represent entries of direct cost. Then there'd be a subtotal. Then there'd be another account line item. In the old nomenclature, most states used 530 as indirect cost. And then the entity would be responsible for taking its approved rate times the subtotal of allowable direct cost. They put that in the 530. And then the combination of 530 plus the subtotal is the amount eligible for reimbursement this billing period. Then there'd usually be the 80 or 50% computation below that, and you'd split it into federal share, state share, etc., local share.
So does, and maybe this is, I think this is the question that Nancy asked earlier, but going back to the minimus rate.
Right.
Does that apply to third-party PPO for-profit companies?
No,
Does not?
no, because the super circular does not apply to for-profit entities. And I do not believe that federal acquisition regulations have developed a standardized rate like that. Private sector varies too much. The assumption in developing the de minimis rate and selecting 10% as the de minimis rate was based on federal government experience in processing indirect cost rate proposals over the years. So there was an experience base. Now, it gets a little twistier in actual practice. If we are an organization where the vast majority of our expenses are personnel-based, you will see, and it is a reasonable option, that instead of taking all your direct expenses to compute the B, the bottom, the basis for distribution of cost, some people prefer to use what's known as S&W, salaries and wages. I don't recommend that as the basis for computing B in the equation, because we in transit have fairly substantial vehicle maintenance costs, pretty substantial fuel costs. And as a result, I believe in some computation of direct expenses that includes everything, because they are significant for public transit operations, be it New York City Metro or be a little 3-vehicle Georgia rural county-based system. If you select the de minimis rate, they have a little unique take on what you add up to be in column B. And it's called modified total direct costs. And there's a couple things that they want you to take out when you compute B. Instead of just adding up all your eligible costs, it's a little subset of this. Like my previous example, we take capital off the top. Then there's a couple other items we must subtract, take off. One of them is rent. Don't ask me the logic for that decision, but that's the way it is. Don't shoot me, I'm only the messenger. If we have subcontracts, say we contract with, let's just say for operations, with TransDev, I just saw their name on a sign-up sheet for the statewide transit plan. Say we contract with TransDev and they operate our transit services for us, or at least provide some support services to the operation. On those contracts, if we're using the de minimis rate, we can count only $25,000 worth of that contract. So if the contract with TransDev is $150K, we can only count $25K of it in our computation of total direct expenses. It's the first, we have to exclude subcontracts in excess of $25,000. So anything above $25,000, we exclude. And that becomes our computation of what's known as modified total direct costs. Then it works like any other indirect cost rate proposal. We take the sum of that direct cost column, we multiply it, instead of 13.7%, by the automatic 10%, and our eligible expenses for reimbursement are total direct expenses plus 10% of modified direct costs. We add the two together, and that's what we submit to GDOT. GDOT is working on and will be distributing soon, for those of you that have elected to use the de minimis rate, a subsidiary worksheet that goes along with the new reimbursement forms that will try to automate that process for you, identify which numbers go in the calculation, which numbers have to be excluded based on use of a standardized reporting tool. We're able to do that. So GDOT is going to provide some technical assistance in that area. So I know that's a little tricky. This is usually above our pay grade. Transit managers, planners typically are not the individuals who do this sort of work. It'll be our CFO, or if they're not comfortable doing it, we'll hire our accounting firms to do it. Just be aware that you don't want the same accounting firm preparing your annual financial audit or single audit. You don't want them to be the same firm that prepares your indirect cost rate. That's not allowed under the rules, and they should know that. Before we talk about the actual construction, if you're going to use an indirect cost rate proposal, usually I like to take an earlier break in the afternoon. So we're just about 3 minutes overdue. So why don't we take our afternoon break now? We will reconvene at 3:18, and we'll talk about elements of an indirect cost rate proposal, and we'll head into the home stretch for the day.